Welcome back. Make yourself comfortable. Allow your shoulders to relax and your breathing to slow. Tonight, you will drift through a story that unfolds quietly, deliberately, and without urgency. This is not a story of sudden revolutions or loud declarations. It is a story of calm conversations, private decisions, and power moving softly in the background. Tonight, you are listening to the story of how the Federal Reserve was born. In the early years of the 20th century, the United States was growing faster than ever before. Factories expanded, railroads connected distant cities, new fortunes appeared almost overnight. But beneath this rapid growth, the financial system was fragile and unstable. Banks operated independently, money supply shifted unpredictably, and when fear entered the system, it spread quickly. Financial panics were common. Ordinary people lost their savings. Businesses collapsed without warning, and trust evaporated almost instantly. The most severe of these crises was the Panic of 1907. Banks failed, credit froze, and the entire nation seemed to hold its breath. As you relax, imagine the uncertainty of that moment. Long lines outside banks, closed doors, whispers of collapse. It was clear to those in power that the system could not continue this way. Something needed to change, but change, especially when it involves money, is rarely simple. A small group of influential men began discussing solutions. They believed that financial stability required central coordination, but they also understood the American public deeply distrusted centralized banking power. The memory of past abuses was still alive. Any openly proposed central bank would be rejected immediately. So a different approach was needed. One that was subtle, one that appeared decentralized, and one that could be introduced gradually, without public alarm. This is where our story begins to narrow. Toward a few individuals, toward quiet planning, and toward a meeting that would take place far from Washington, far from the press, and far from public view. As you breathe slowly, allow yourself to drift closer to that moment. A private train, a winter night, and a destination known as Jekyll Island. In November of 1910, the plan moved from discussion to action. 6 men gathered in complete secrecy. They traveled under false names. They avoided public attention. Even their servants were instructed not to speak of the journey. The train departed from New Jersey and moved quietly south. Windows were covered. Conversations were hushed. Each man understood the importance of silence. They were not merely attending a meeting. They were shaping the future of American finance. Their destination was Jekyll Island, a private retreat off the coast of Georgia. Access was strictly limited. Only the wealthiest and most powerful families in America were members. Rockefeller, Morgan, Vanderbilt, Astor. It was the perfect place to avoid scrutiny. Inside a private lodge, the men began their work. Days passed in careful discussion. Every word mattered. Every structural decision carried long-term consequences. Their goal was to design a central banking system without ever calling it that. Paul Warburg played a central role. He had studied European banking systems extensively. He believed a similar model was essential for American stability. But he also knew it had to be disguised. The public would never accept a system that appeared too centralized. So the structure was layered. Regional banks would exist, authority would appear distributed, and the name would emphasize federal cooperation rather than control. Language became their most important tool. As you relax further, imagine the quiet intensity of that room. No raised voices, no dramatic gestures. Just steady, methodical planning. They were not rushing. They were designing something meant to last decades. When the meeting ended, the men departed exactly as they arrived. Separately, quietly, without explanation. No public record acknowledged what had taken place. For years, Jekyll Island remained a secret. But the plan they carried back would soon emerge in a different form. One that appeared reasonable, even necessary. Once the plan returned to Washington, it was carefully refined. Details were adjusted, language was softened, and opposition was quietly managed. The proposal was framed not as a concentration of power, but as a safeguard against chaos. In 1913, during the holiday season, the Federal Reserve Act was passed. Many legislators were absent. Public attention was elsewhere. President Woodrow Wilson signed the act into law. The Federal Reserve was officially created. Few Americans understood what had truly occurred. The system appeared complex, technical, distant from everyday life, but over time, its influence became undeniable. The Federal Reserve gained the power to influence interest rates, to control credit availability, and to stabilize or destabilize entire markets. Supporters praised its ability to prevent panics. Critics warned of unchecked authority. But regardless of opinion, its presence shaped the modern financial world. As years passed, the origins of the system faded from public memory. The secret meeting on Jekyll Island became little more than a historical footnote. Yet the decisions made there continued to ripple outward. As you rest now, consider how power often moves. Not through force, not through noise, but through quiet consensus, through planning, through patience. The story of the Federal Reserve is not one of villains or heroes. It is a story of systems, of intentions, and of consequences that unfold slowly over time. Now, allow this story to soften. Let it drift gently into the background, like waves moving steadily toward the shore. Your breathing is calm, your thoughts are light, and the night is quiet. You can let go now. The story will remain, and sleep can take over. As you continue to rest, allow the story to move forward, slowly and calmly. Once the Federal Reserve was established, its presence was felt quietly at first. There were no dramatic announcements, no sudden changes that demanded public attention. Instead, the system settled into place like a new rhythm beneath the surface of daily life. A rhythm that most people did not consciously notice, but one that would influence nearly every financial decision made in the decades to come. Regional Federal Reserve banks were created across the country. Each appeared independent, each appeared local, each appeared familiar and accessible. But together, they formed a coordinated structure unlike anything America had seen before. A system designed to balance control with the appearance of decentralization. Unity disguised as separation. Money could now be created in response to demand. Interest rates could be adjusted. Credit could expand or contract, not by chance, but by design. This marked a fundamental shift. For the first time, the supply of money was no longer tied strictly to physical reserves. It could be influenced by policy, by judgment, by interpretation. To most citizens, this system remained distant and abstract. Numbers on paper. Policies discussed in closed rooms. Decisions made far away. Daily life continued as usual. People worked. They saved. They borrowed. They spent. Few stopped to ask who controlled the flow beneath it all. But over time, patterns began to emerge. Periods of optimism followed by moments of fear. Booms followed by busts. Times of easy money followed by sudden tightening. Markets rose confidently, then fell unexpectedly. Again and again, supporters argued this was progress. That economic cycles could now be managed. That instability could be softened. That panic could be prevented before it spread. They believed that without this system, chaos would return. Bank failures, frozen credit, lost savings. Critics, however, saw something else entirely. They questioned who truly controlled the system. Who benefited first when money expanded? And who suffered most when credit dried up? They noticed that new money did not enter the economy evenly. It arrived first in financial institutions, in markets, in large organizations. Those closest to the source felt relief and opportunity. Those farther away felt pressure and delay. During times of expansion, wealth flowed easily. Investments grew. Asset prices climbed. Confidence increased. Debt felt manageable. Risk felt distant. But when contraction arrived, the effects were uneven and abrupt. Small businesses struggled to refinance. Workers faced layoffs. Savings lost value. Opportunities narrowed. Yet the system itself remained intact. And so the cycle continued. As decades passed, the Federal Reserve's role expanded quietly but steadily. New responsibilities were added, new tools were created, new powers were justified by new emergencies. During wars, it financed massive government spending. During recessions, it lowered rates to encourage borrowing. During crises, it intervened directly in markets. Each action was presented as necessary. Each decision framed as temporary. Each intervention described as exceptional. But temporary measures have a way of becoming permanent. What was once unthinkable became standard practice. What was once rare became expected. As you breathe gently, imagine the slow accumulation of authority. Not seized in a single dramatic moment, but built gradually, step by step. Decision by decision, the system grew more complex, more technical, more insulated from public debate. Language became specialized, processes became opaque, understanding required expertise, and with complexity came distance. Most people no longer questioned how money entered the system. They simply accepted that it did, that it must, that it always had. The origins were forgotten, the structure normalized. Power no longer needed to justify itself. It had become routine, quiet, embedded, efficient, and the world adjusted around it. Now, let the story drift gently into more recent times. The 20th century slowly gave way to the 21st. Technology accelerated everything. Information moved instantly. Markets reacted in seconds. And at the center of this faster, more interconnected world, the Federal Reserve remained. Interest rates became signals. Small adjustments carried enormous meaning. A fraction of a point could influence millions of decisions. Investors listened carefully. Governments waited. Markets learned to anticipate every word. Statements were no longer just explanations. They were events. A single sentence could move global markets. A pause could create uncertainty. Even silence carried weight. Over time, the Federal Reserve became more than a financial institution. It became a stabilizing force. Or, depending on perspective, a guiding hand. During moments of economic stress, attention always returned to the same place. What will the Federal Reserve do? How far will it go? And when will it stop? As financial instruments grew more complex, so did the tools used to manage them. Traditional policies expanded into new territory. New mechanisms were introduced. Old boundaries were quietly crossed. The system adapted, and the world adapted with it. During major financial crises, the Federal Reserve acted with unprecedented speed and scale. Liquidity was injected into markets. Interest rates were pushed lower and lower. Assets were purchased in vast quantities. These actions were described as emergency measures, temporary responses to extraordinary circumstances. Supporters praised the results. Markets stabilized. Confidence returned. Collapse was avoided. Critics raised different concerns. They warned that constant intervention altered natural signals. That risk was no longer priced accurately. That consequences were being delayed rather than resolved. Over time, expectations shifted. Markets no longer asked if intervention would occur. They asked when. Dependence grew quietly. Governments relied on continued access to cheap credit. Debt expanded steadily. Financial systems adjusted to a new normal. And beneath it all, a deeper question remained. What happens when stability itself depends on constant support? As you breathe slowly, consider how subtle this shift has been. Not sudden, not dramatic, gradual. A system originally designed to respond to panic had become a source of reassurance. A foundation of confidence. And confidence, once established, is difficult to withdraw. The longer support continues, the harder it becomes to remove. Now, allow the story to widen again. The meeting on Jekyll Island was never meant to be remembered. It was designed to disappear into history. And in many ways, it succeeded. The individuals faded. The secrecy dissolved. The moment passed. But the structure endured. What began as a carefully designed solution became a permanent feature of modern life. Not driven by villains. Not guided by heroes. But shaped by incentives. By systems. by decisions made under pressure. As you relax further, notice how power often moves. Not loudly, not forcefully, but patiently, through committees, through policy, through language. The story of the Federal Reserve is not a simple one. It is not a story of absolute control or absolute failure. It is a story of influence, of trade-offs, of long-term consequences unfolding slowly. Now, let these thoughts soften. There is nothing you need to solve tonight. No conclusion you must reach. Only awareness, an understanding that the world we experience today was shaped by choices made long ago. Often quietly, often out of sight. Let the story fade gently now. Like distant echoes, like waves retreating into the dark. Your breathing is calm, your body is at rest, and the night continues, steady and quiet. Sleep can take over now. If you enjoyed this video, please consider giving it a like and subscribing to the channel. It really helps support the content. Thank you for watching.